I think this was largely expected. I think that many companies are right-sizing their staff for what's likely to be a more incrementally challenging period in demand from the macroeconomy versus the last 2 years. And I think a lot of companies are using this as an opportunity to get more efficient and to align their cost structure with their revenue base. And Microsoft's, one of the largest companies in the world, if not sometimes the largest. So they're more macro exposed and more macro impacted than many other companies. And so, I think this is the right move for the times that we're heading into. It is pretty easy for most companies to cut 10 to 15% of their employee base right now, particularly after the run in hiring that we saw over the last 2 years, and not really skip a beat. Meaning that these types of cuts would not impact their ability to grow, their ability to sell, and even their ability to innovate. So while it does sound like a large number, it likely isn't as impactful as maybe something like a 20% cut that you've seen some other companies do that are much I would say more secularly impacted. The areas that typically are the last to get cut is the builders and the sellers. So the engineers and the salespeople within enterprise software, they're the last to get cut. Those are the highest on the totem pole. You could see recruiters, HR staff, people around the builders, so product people, product managers, customer support. Those are more likely the jobs that are kind of first in line to see that type of an impact or reduction, in addition to obviously contractors or professional services people as well. So we're very bullish on the long term, both for Microsoft, but also for many of the other enterprise software companies in our coverage. Microsoft specifically, we think is thematically extraordinarily well positioned to be the next generation intelligent operating system for work. You can see the press and kind of the way they're aligning and have been aligned with OpenAI and ChatGPT. We believe we're in the dawn of a new age, and Microsoft is one of the best positioned companies to usher that age and monetize that opportunity. And so while we do believe that over the short term and maybe even the intermediate term, the next quarter, the next few quarters, you might see a little bit of a digestion period as growth is adjusted from a sugar high post-COVID to a more normal kind of pre-COVID run rate. We do think that once we've rebased that comparable, the future is very bright, and we see a lot of opportunities for Microsoft to continue to gain share versus the competition.
The overall labor market has been remarkably resilient. The latest data we have through December suggested it is holding up despite higher interest rates. That said, there are some pockets where we are starting to see a clear slowdown, most notably tech, but also finance and real estate. And so over the past few months, we've had something close to 200,000 layoffs in the tech sector. That may feel big. A lot of these are very high-profile companies, but it's important to keep in mind that tech overall, depending on how you define it, is at most 12 to 15% of the US economy. There are still a lot more corners of the economy where the labor market is tight. Tech is the exception right now. Fundamentally, a lot of companies in tech are grappling with the consequence of higher interest rates. At the end of the day, a higher interest rate is a higher cost of risk. And tech companies are in the risk business. They make bets on the future, on ideas, with the hope that those ideas are going to be profitable at some point down the line. The cost of waiting just got a lot more expensive over the past year. And so a lot of them are reevaluating their business lines, reevaluating their investments, and also reevaluating kind of the high labor costs that they've accumulated in the very tight labor market over the past year and a half. Through December, it looks like a lot of tech workers that were laid off early in the cycle have found new jobs relatively quickly. It is obviously an open question the degree to which the workers who are laid off in January with hiring freezes and fewer job opportunities out there, it's an open question the degree to which they will have a similar experience and find new jobs. That said, the tech skill set, be it engineering or data science, is incredibly valuable. And so in some degree, we are seeing tech become a little bit less techy and traditional companies become a little bit more techy. So these tech workers are finding roles often in more traditional industries that they may not have considered otherwise. So in some ways, tech is becoming less exceptional and the rest of the economy is benefiting from this skills transfer.
Well, since Satya took over, he's taken the company from 60,000 employees to 220,000. So they're cutting back on 10,000, which is not too surprising. Many of the tech companies are kind of cutting back. Revenue growth is coming in a little bit slower than expected, particularly on the cloud side. So I think for the whole industry, he has some cover to kind of, I think, pull out some of the weaker workers or pull back in some areas that are not as strategic or not, working as well as expected.